Hello everyone, we've just had the FY25 Union Budget, the first budget of the coalition government, come into the picture, and today we're going to take a closer look into it. I have always maintained that Union Budget, like a budget of a household or a business, is about cost and expenses. So today we will look at the Union Budget of India with the same angle. The two things that make accounting a good practice is credibility and continuity. We want governments to have budgets which are credible, which means that they will be able to deliver what is promised, and continuous, which means that the policy continuity will help the businesses to grow and there is an element of ease of doing business in the economy. Let me dive into the budget of today and take a look into it from three big angles. First angle is the expenditure, which is where does the government spend, and it is also the segment which is most closely watched at by the investors, by the markets, is because we all expect certain sectors to get some benefits. In my personal opinion, today the government made the budget for a longer period of time in which they have decided to address the structural issues of the economy. In the last 5 years, we have raised issues like India has a lot of youth dividend, which means our demographics are aligned towards more working age population, but we do not have enough jobs for that population. And therefore, even if we are growing at 7% today, we may not be able to sustain this growth rate if we are not able to create those jobs. So this budget has comprehensively addressed the employment problem that we were foreseeing by offering internships, by offering incentives to companies, and also helping with the shift of unorganized sector to the organized sector. Additionally, there has been an abolition of angel tax for startups that have raised up to 10 crores, which means that it also helps the whole startup ecosystem of India, and it will have a multiplier effect on the economy by creating more jobs and therefore have a more sustainable rate of growth. So maybe we are looking at 8% potential output for India for the next 5 years. Second problem that we've been facing, in which I have always maintained that the fiscal policy needs to come hand in hand with the monetary policy, is that of inflation. We are currently having a significantly high inflation that we are not finding comfort in. I believe the reduction in customs on precious metal, etc., will help in curbing headline inflation for India, which will give more space to monetary policy, to RBI to act later in terms of rate cuts as and when the Fed starts cutting rates. The third problem of India has also been in our inability to export up to our potential. So India is a country where value-added exports have historically played a very, very valuable role. Today we heard about shrimp. The marine products export market is as big as $7 billion. Gems and jewelry, mobile phones. India became a manufacturing hub as the world decided to look away from China. And as we know the geopolitical situation that stands today, if Trump is able to come to power again in US and if anti-China sentiments continue, it is our responsibility to be ready to export to the rest of the world. And I believe the reduction in customs for importing mobile parts, reduction in customs for shrimps, etc., will make our exports more competitive in the global markets. It will help to get more trade surplus. So on the services side, we have the global capability centers clicking in, and now we can do better on the value added goods as well, which will help the overall macro picture. In essence, I feel the expenditure targets that were laid or the policies that were described today were not about this year, but they were rather about the long-term priorities of the government. And I feel these structural reforms, if are maintained on continual basis, which means that if they continue to lay money on these schemes and are able to disburse it on time will have a long-term compounding effect on Indian economy. Now let's move on to the second part of the budget, which is the receipts part of the budget, which is where I think the financial markets in particular are not very happy, and this has to do with taxations, which has been made not so friendly for the investors in the listed space. We are talking about increase in long-term capital gains. We are talking about increase in short-term capital gains, STT, increase in taxations for FNOs, all of which combined does harm the investors in the financial markets. But I would still say it's a bit on the margin, one, and secondly, even yesterday's economic survey has warned the risk of financial liabilities that is building in India, and therefore if prudence has to be taken by regulators, so be it. So I think these were small nudges which is helping government create revenues. So these tweaks have not really been welcomed by the financial markets, and rightly so, because you reduce from your returns by paying extra tax. Having said that, I feel in the long term these effects are likely to fade out, and the knee-jerk reaction was initially at the start of the budget. By the time the markets end today, there would possibly be some more recovery that would kick in. Having said all of it, and while we embrace the big fiscal policy that we heard today, there's one thing that would be a demand from the government, which is continuity in policy. The third aspect of the union budget is obviously the fiscal deficit. So the big number that we are talking about is the fiscal deficit, and it moved from 5.1% to 4.9%, which is a good thing because we are on a glide path of fiscal deficit to 4.5% in FY26, which is literally one budget after. Having said that, bond markets did not seem very happy. This is because net market borrowings announced were higher than those were announced in February 2024. So the current number stands at about INR 11.5 trillion, which means that more bond issuances are going to go in the markets. There could be RBI help that could come up in coming months as RBI monetary policy rolls out. But for today, this number wasn't very pleasing for the bond markets. Now, having looked at the three components of the budget, let's take an overall look and what it means for the various asset classes. For equity, I would say that definitely for investors there is a bit more taxation than before, and that has not been rightly so a welcome move. Having said that, because we are making structural changes in the economy, we are incentivizing companies to create jobs, we are making the economy prepare itself for the next India, which could be India Viksit Bharat 2047 that we are talking of. I think the overall macro growth that will come in will eventually seep into companies' profits, will create earnings, and will make India a very investable economy in the future. Secondly, on the bond market front, markets seem moderately unhappy today. On the real estate side, it was an interesting budget because indexation benefits will no longer exist, and therefore making real estate slightly unfavorable. On the commodity side, especially gold, because of the reduction of customs duty to 6%, it will most likely be passed on to the final consumer, and therefore the INR prices of gold could look marginally lower even if the USD prices continue to go up. So I think that's it from my end. This is the first cut of the union budget as we have it today, and we will deep dive into what it means for your portfolio, what it means for your investments. So stay tuned for that. Thank you very much for tuning in.